What is the risk in the Chinese economy to its massive debt pile?
I think you need to understand China from the viewpoint of the whole global context. The whole world is changing very, very fast indeed. And China is moving from what I call an old supply chain of energy, resource consuming industries to provide goods and services to mostly physical goods to the rest of the world towards a service economy. Service economy last year just moved to 50% of GDP. In the US, it's about 70, 80%. Hong Kong nearly 90%. So China's moving towards a more sort of a middle income advanced economy transformation. During that transformation, you will see some funding requirements, and it's not surprising some leveraging occurred. But that's more due to an asset and a liability allocation issue. First thing you need to remember in China is that its savings is 50% of GDP. So it's a matter of distribution between debt and equity.
But a lot of those savings also went into risky off-book wealth management products.
Well, you had the junk bond market in the United States, and look at what happened. That a lot of those junk bonds finance a restructuring of cable TV and a lot of these infrastructure that restructured the economy. Okay? So there were losses, but there were successes. And so you need to understand China is going through creative destruction. The old industries need to be phased out. Over the last 5 years, the government has been extremely good at phasing out excess capacity. Now, there are some industries out there that haven't been folded up yet, but it is a matter of time.
Do we know the full extent, though, of the bad liabilities, the assets that are underlying those traditional industries that are suffering? The state-owned enterprises, the zombie companies. Do we know the full extent of it?
No, I think the banking industry knows pretty well, and the banking industry, the bulk of it. But there is part of that shadow banking area where the authorities are looking at it in great detail right now, and that's where the enforcement and the crackdowns, if you may call it, has been occurring.
What is the likelihood, though, of a banking crisis in China?
I don't think there will be a banking crisis for the economy, but you will not be able to avoid some individual institutions having to be wound down.
Mm-hmm. This deleveraging campaign, you don't think, though, that China is over-leveraged?
No, because you see, if you think China is over-leveraged, is Japan over-leveraged? Japan's gross debt is at the moment higher than China.
Well, Japan's a different kettle of fish. I mean, it's had 2-3 decades now of stagnation. China is a very different thing. They are spending their way to stabilize growth.
But Stephen, most countries grow out of their debt. You have real trouble when you're not growing. China is still growing at 6. In fact, the first 4 months of this year, growing at 6.9%.
If you can trust the numbers. Do you trust the numbers? Jilin province, Inner Mongolia, Liaoning province, they've admitted to fudging the numbers.
Never forget that China is 1/5 of mankind. It's a huge country. It's the second largest economy in the world. When you're a very large country, are you surprised that one part of the country is slowing down or even declining, and a large part of the country is growing? The very fact that just north of Hong Kong, the Pearl River Delta, what you call the greater, Guangdong, Macau region, is growing pretty good, and it's all high tech. Shenzhen is today the prototype center of the world, with lots of new technology companies growing.
Well, that begs the question, too. Shenzhen, I'm just looking at some of the data from 2016. The Shenzhen economy is now worth, what, 281 billion.
Yes.
Hong Kong is 321 billion.
That's right.
If we're celebrating the 20th anniversary here, Hong Kong was 177 billion 20 years ago. Shenzhen was 14 billion.
Absolutely.
What are the chances? I mean, it's going to happen. Shenzhen's going to dwarf Hong Kong. Where does Hong Kong then find its competitive advantage beyond just financial services?
I think you must understand that growth today is not standalone. It's a cluster. And Hong Kong is sitting in the real growth zone of China and Asia. Geographically, it's very, very well located. It's very low cost. I mean, it's high cost property, but the volume that you have means that the marginal cost actually is fairly low. And, you know, it's actually working very closely with now the Pearl River Delta, you know, to help. I mean, look at the investment banking that's going on, helping, you know, Chinese enterprises raise capital.
Is there a property bubble here, though? If you look at the
property
risks.
bubble is worldwide. Let me put it this way. Okay, the property bubble is worldwide because interest rates are historically low. So, you know, I am a great supporter of the Fed adjusting back to normal. And I think when it adjusts back to normal, you know, property prices will adjust. How it will adjust, I can't predict.
What about the PBOC's balance sheet as the Fed is unwinding its balance sheet? I want to bring up this chart. We won't be able to see it. Our viewers will. #BTV9323. It's about the $5 trillion asset hoard, if you will, the PBOC. So as the Fed unwinds in a tightening move, the PBOC has seen its hoard, its asset pile, kind of stabilize. Do you think they could start unwinding as well to tighten up?
Up to a point. I think just as the Fed has problems unwinding too fast, so is China facing this issue. The central bank, we cannot run away from the fact that globally central banks' balance sheets are much larger than before. The Chinese central bank's balance sheet was increased because of the increase in foreign exchange reserves.
Right.
Now that, you know, there's been some decline in the foreign exchange reserves, the liquidity needs to be replaced through open market operations. And that's exactly what's happening. But look at the way the interest rates are behaving. Actually, the interest rates are now following real market rates, which is exactly what the direction of reforms is to let the interest rates reflect market signals. And I think that they're doing a great job.